Welcome back. Bruce Porter joins us now for this week's Dollars and Cents segment. Going to help us manage our money. Good to see you again, Bruce.
That's what we hope for.
That's what we hope for.
That's
and
right.
It's good to start that right now before it's too late. We're going to talk about thinking outside the box when we're trying to find a better interest rate income. Interest rates, that's tricky.
Well, it is. I mean, traditionally, when people start talking about income and using interest to provide that, there's really three tools that people have used: fixed interest, bonds, or dividends off stocks. So, you know, those traditionally have paid out. People have been happy with it. Rates have been decent, things like that. Well, for the last 8 years, we've all been suffering with this declining rate environment, which now is having long-term effects on the Fed's rate ability and banks' abilities and bonds' abilities and stocks' abilities to bring those dividends and bonds and interest rates back up. Well, when you look at, let's take fixed interest, for example. National average of a one-year CD right now is 1.21. So it has come up from a year ago. It was a lot lower than that. Money market instruments, 0.95. Those are your more cash checking, high yield money market type
Better
checking.
than a savings account, but not a whole,
Savings accounts are still lagging at 0.5. So again, there's not a lot of differences in rates with banks. You can look online. You can get a whole list of banks. I searched Missouri. And got these rates. So you can look at hundreds of rates. And if you're shopping for an interest environment with a cash type account, bank policy type account, get on the internet, look around, see what you can find, because there are rates out there. Bonds. Well, there's treasury bonds, there's corporate bonds. You look at treasuries, 10, 20, 30-year yields, 1.75 to 2.61. And then corporate bonds, a little bit better, 2.5 up to 4.26. But again, you're tying up your money for a period of time. And you got to remember, the one thing bonds are notorious for doing is having call options. So if they call them, you're out, and they're going to go somewhere else. So we got to keep that in mind. And I got online, looked at bond rates all over the spectrum, and there's a variety of things to look at. And there's some different types of bonds. But to keep it simple, these are the most secure type environments. Now, dividends. We've talked about this on previous shows. Dividends, they trend with the markets. Stock prices are up, everything's looking great, dividends are up. But the minute the stocks plummet, what happens to dividends? 08 and 09 were very important years in our education because we watched dividends drop as much as 70 to 80%, as well as stock value.
And you know, for a long time, people made a lot of money. They would maybe reinvest those and get a lot more stock, you know, and then all of a sudden the bond can drop out.
Traditionally, people have used dividends and bond type rates. You know, a typical portfolio is going to be half and half in retirement. And they've always based their dividend rate or their dividend income and their bond income, and that supplements their retirement. Well, when those all suffer because of the environment we're in, you have to think outside the box. So, and again, dividends, again, are not guaranteed. So now, to think outside the box, just one idea that I want to give everybody is don't discount the value of an insurance policy. We insure our homes, we insure our autos, we insure life, health, we insure everything that, for the most part, is replaceable, except our money. So now if you just take that to the next step, if I insure my money, can I get guaranteed principal? Can I get guaranteed growth? Can I get guaranteed income? Can I get guaranteed liquidity? And the answer is you can. Those products are out there available. There's lots of different names for them. Some people call them a private pension plan. Some people call them a fixed annuity, an indexed annuity, or a combination of these things. But using a piece of that in addition to the portfolio you have can provide you with some stability, even to the tune of, say, 4 to 7% income stability, and give you a lot of guarantees that you really can't get elsewhere.
And that's not bad. I never really thought of it as, in terms of insuring your money. But that's right.
Well, that's the one thing that we've worked our whole life for, that we're too old to replace.
Exactly.
So why not insure a piece of it, if not all of it?
So someone could, if they're interested, could come and talk to someone like you, a financial expert who could really sit down with you and talk about what you're up for and what your goals are before you get into something like this long term.
Absolutely. The main thing is, if you have questions, seek advice.